Cole Porter warned us that anything goes, and he wasn't kidding. Nearly a century later, the Fed is cutting rates in the dark while the government is shut down, and both stocks and gold are hitting records. In a world where good's bad and black's white, the only thing that still makes sense is earnings. Cole Porter famously wrote The World's Gone Mad Today back in the 1930s. Possibly the first to get on the good's bad today, black's white today bandwagon. Those are his actual lyrics. If he only knew that almost a century later, the government would stop paying employees and lock its doors, and politicians would be bickering over social media, he might have written that lyric a little bit differently. Porter penned that music long before the Fed used the Fed funds rate to manipulate inflation and the labor market. Back then, the Fed was just trying to keep banks from closing their doors. A pretty simple mission: keep the system liquid. In those days, the Fed controlled economic activity loosely through the discount rate, the rate which banks could borrow directly from the Fed's discount window. Banks still do that today, but rarely because it signals weakness. Instead, banks prefer to borrow and lend to each other overnight, using what we now call the Fed funds rate. You know that. In Porter's time, the Fed was a lender of last resort, trying to prevent another 1907-style panic. It wasn't until the 1950s that the Fed began to manipulate bank-to-bank lending rates, and the modern Fed funds rate was born. And here's a fun fact. The Fed doesn't set the rate, the Fed manipulates it. It uses open market operations to achieve its target. So when you hear that the Fed cut rates like it did last month, what actually happened was that it lowered its target rate to 4.25% from 4.5%. The way it does that is through buying and selling treasuries or using repos and reverse repos to push the market rate where it wants it to go, its target. You don't need to memorize that because it's not going to be on the test. But you should know that the Fed is extremely active in the public markets. Why? Because its now famous dual mandate didn't even exist until 1978, when the Humphrey Hawkins Full Employment Act made the Fed responsible for both stable prices and maximum employment. Now, that sounds familiar, right? In other words, it became the country's most powerful economic player. Fast forward to today, and markets have become hyper-fixated on Fed policy. Earlier this year, investors were like a treat-addicted puppy, begging for rate cuts and chasing any hint of dovish language. But more recently, the focus has shifted. Now, markets see rates as the difference between a soft landing and maybe a recession. The Fed, like a responsible parent, is in no rush to hand out treats. And that tension has led investors to hope for bad economic news, because bad's good today. As Cole Porter might have said, anything goes. The Fed relented a bit last month, cutting its target in response to a string of weak labor reports. Monthly numbers, along with annual revisions, show clear signs that the U.S. job market is cooling. But even as central bankers admit that, they're in no hurry to say it out loud. The result? Markets keep powering higher anyway, and it's not because of the Fed. We're in the middle of a massive economic expansion, which is fueled by efficiencies of, you guessed it, AI. That's not hype, that's real productivity growth. And consumers, backed by strong jobs and healthy balance sheets, are still spending. And GDP, it confirms that. Last week, the S&P 500 hit 2 all-time highs in the middle of a government shutdown. Think about that. The government is closed. The Fed's data feed is partially blacked out, and yet the market keeps climbing. If that's not an anything goes economy, I don't know what is. We missed the labor report, we missed jobless claims, and still investors ran up stocks. But here's the twist. Gold, the classic doomsday trade, also hit all-time highs, above $4,000 an ounce. Normally, when stocks rise, gold falls. One is a risk-on signal and the other is a risk-off signal. But now, they're both rising together. That's not just unusual, it's historically rare. So yes, black's white again, to use Porter's words again. But the party ended, at least briefly, when President Trump and China started their saber-rattling again on Friday. Markets hate uncertainty, and this time they got a heavy, heavy dose of it. Look at this chart. The white line is the S&P 500. The blue line is gold. Stocks just below all-time highs and gold at record levels. That doesn't happen by accident. It means investors are hedging, betting on both euphoria and disaster at the same time with two different hands. The question is, which one is right? The answer, as always, is earnings, my friends. Corporate profits will decide whether stocks keep climbing or gold's warning comes true. The Fed can only manage liquidity, but companies drive real value. And guess what? Earnings season kicks off tomorrow. How convenient. JPMorgan Chase reports in the morning, the unofficial start of Q3 results. Expectations, though, are sky high, especially for financials. Last quarter, banks surprised big time. This time, investors want confirmation that consumers are still strong and credit is still flowing. The bar is high for everyone. In this world where economic conditions seem to flip daily, where the Fed is dovish one day and hawkish the next, and where the administration is fighting with China on Tuesday but making up by Friday, or vice versa as last week, the question becomes, will good be bad tomorrow or bad be good tomorrow? The reality is that good is still good. In the long run, strong profits and solid growth always win out. Cole Porter wrote his masterpiece during the Great Depression when everything felt upside down. And yet, even then, the economy came back. So while the world may look mad today, remember that markets have always survived madness. Stay focused, stick to your principles, and keep your eyes on the music. So, your truth bomb for today is this. When everything seems upside down, remember that markets eventually turn right side up. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.